Alhamdulillahi Rabbil Alameen. Assalatu wassalamu ala Rasulillah. Assalamualaikum warahmatullahi wabarakatuh, everyone. You are here to continue on our analysis of bank risk-taking behavior. Now we would like to look at the Islamic conception as well, given that previously we have tried to clarify that sometimes we tend to say that the conventional bank is based on riba, and the evil of riba is in the form of zero risk-taking. So in the sense that in the riba contract, the contract of loan has accorded to the bank a guaranteed profit plus capital. So in the sense that the banking system, the conventional banking system, is able to garner that amount of profit with capital recovery without taking any risk, meaning that if there is a default, then the bank can take a legal action against the borrower, or if the loan is secured, then the bank can sell the collateral in order to recover the loan. So that is essentially the background, what we have been doing earlier, and for that reason, this particular imagination that the conventional bank do not take any risk is not right, because there are ample literatures that suggest that bank take risk. So we have credit risk-taking, we have market risk-taking, we have liquidity risk-taking, we have operational risk-taking in bank risk management. So bank actually take financial risk when they make loans, right? So that is the issue here. So the meaning of risk-taking in conventional banking is that to make more profit, bank must make more risky loan with higher interest rate. So that would be the setup where we are looking at the conception of risk-taking in conventional banking. It is different from the risk-taking concept in Islamic banking, where our focus will be first at the ownership risk-taking, based on the fact that the bank must purchase the asset from the supplier before selling the asset to the buyer on credit. So prior to the resale, the bank is the legal owner. The bank puts the asset on their balance sheet, and that is an evidence of ownership and the bearing of ownership risk. So that is one level of risk that we must be able to recognize in Islamic banking. And then when the bank make the credit sale, then the bank will face another round of risk-taking, but this will be financial risk-taking, which is similar to the conventional bank risk-taking, which is financial risk-taking that does not involve business risk or commercial risk or ownership risk. So we see that this is true. So this idea of bank risk-taking must be in that form of the incentive to make more profit is driven by the fact that bank must make more risky loan, because risky loan will charge higher interest rate, right? So if the bank want to be prudent by making secured loan, they can survive, they can sustain their business, but there will be less profit compared to banks that are more aggressive. Of course, we know right away that this behavior is coming from the leverage model, where banks uses deposit fund to make loan. So the deposit fund are money not belonging to the bank, it belongs to the depositors. And so that might be a factor to see, because when banks do not use their own money to make the loan, there is a likelihood of moral hazard, because the money they use does not belong to them, it belongs to the depositor. So there's a likelihood that bank can be a bit irresponsible, and they don't mind making more loans or more risky loans, because this will be able to charge higher interest rate and more profit. So this kind of aggressiveness is very dangerous, and that is why we have in the bank stop limits or concentration limit to ensure that this kind of strategy to make more money by making more risky loan is under control. But again, I say that all of this will be out of control under a weak oversight of board members and top management. So they must be, they must have strong oversight to ensure that bank follow the proper risk management process. They must identify the risk, they must measure the risk, they must mitigate and report the risk, so that we have that kind of risk governance, that will be able to ensure that even though bank make money by making more risky loan, but this will be under control. Yes. But again, I like to emphasize the fact that even if the loan contract has secured the bank the profit payment from the interest rate and the capital recovery, with a secured loan, the debt created will be much lower than unsecured loan. So this security that the bank holds when they make a loan doesn't imply that they can actually be able to actualize the repayment, because actual repayment hinges on the borrower's ability to pay, right? So again, as we see over time, over 5 years, anything can happen. There can be a recession, there can be economic downturn that make it difficult for the borrower to pay their debt. And we can see that if the risky borrower default, then the bank bears the loss. So even if the bank have been able to secure a fixed income and capital recovery from the loan contract, but still there is what we call residual risk when weak oversight of the board members and top management can lead to the miscalculation of credit risk. That can hurt bank when bank make lower provision as expected. So when the bank have been miscalculating the credit spread, so they make less loan loss provision, which is not sufficient to absorb any of the actual loss when it occurs. So this is a very important point for us to. So here I would like to just say that this concept of risk taking is quite a dangerous concept because it is coming from a riba system, and the riba system can prey for risky borrower by offering them high interest rates. So it can make people falling into debt. And this is what we see in the 2007 and 8 US subprime loan crisis, where aggressive lending has, in the short run, make banks lots of money, but eventually it turned into a big disaster when the risky borrower defaulted on their loans. Right? So banks have been given ninja loans, and or loans with adjustable rate, and when interest rate goes up, so does the monthly payment, and of course that will cause tough time for the risky borrower to pay up, and that causes the big defaults in the US economy in 2008 and 2007. So again, Islamic banking is also exposed to this kind of risk-taking behavior, even though we can see that the type of risk the bank face will be much more intense compared with conventional banking, because the Islamic bank that is doing murabaha, for example, by purchase order, they will have to bear first what we call ownership risk before the resale. So before the bank sell the asset to the customer on credit, the bank must obtain the asset from a supplier through a sale, right? After which the bank will be taking ownership of the asset and bearing the ownership risk. And after resale on credit term, then the Islamic bank will face another round of risk, and that will be financial risk like credit, market, liquidity, and operational risk, where the Islamic bank will have to make use of the similar tool used by conventional banking in managing those financial risk. So this is a very important junction for us to really provide clarity to the conception of risk-taking in Islamic banking. So we have the concept of risk-bearing, risk-taking, risk transfer. We also have this conception of risk and uncertainty in contract, which is gharar. So inshallah, as we move on, we will be able to provide good clarity on this term, so that as we educate ourselves about Islamic bank risk management, we are very clear what is our objective and how to actually understand what's going on in the Islamic and conventional banking business. Okay guys, we can stop here. I'll see you again. Thank you very much. Assalamu alaikum warahmatullahi wabarakatuh.